It's a very, like, as I looked at the titles we were covering, I'm like, oh my God, I could spend an hour on each and every one of these. Like, there's so much here, and we're trying to really scratch the surface with some of these things here. So I would love maybe as feedback in the end, if you are like, hey, we want to spend a bit more time on either of these topics or a completely different topic, give that as a feedback, and I can work with Marianne to see if we want to do that in the future to get you more knowledge, more understanding around those topics. So with that being said, we are going to cover a lot of stuff here. So I am covering, again, the basics, you guys understand, and if there's more details, we'll get into that as your questions come in. Let's see, I just want to make sure I'm on the right screen. All right, so key topics we're going to cover today. We are going to be covering about how do you understand valuations? Like what happens when the investors come in and how do they justify the numbers that they're looking at? We'll talk about equity and ownership, what's cap tables, if you guys are familiar with that. What happens with dilution? How does that work? What are the different types of strategies you should be looking at? How much equity you should be putting aside to get your key talent at the beginning. So we'll cover bit over there. Then we'll move on to some of the funding options. There's dilutive versus non-dilutive funding resources out there. Which one makes the sense for you, depending upon what stage you are, what you have access to. And then we'll kind of wrap that up coming together as to what's the right sense. We'll just kind of compare the different options available to companies typically at seed and Series A. And then we'll kind of wrap it all together with financial projections, which is what I focus on. And I love and very passionate about accounting and finance. So kind of how that helps you kind of weave this whole story together. Now, keep this in mind. This slide deck is mostly targeted at seed to Series A companies. My experience has been all Series B and up. So I can speak to a lot of my personal experience as well. And if we want to talk about a little bit more late stage, we can definitely talk that in a future workshop. All right. So the first thing, understanding startup valuations. How do you do that? Now, there's a lot of things out there that can kind of help you figure out what your valuation is. Typically, for the most startups, it's really what's your ARR, what's your MRR. ARR is your annual recurring revenue. Now, some of you might be in a stage where you don't have ARR yet. You're still building out your product. You don't have any revenue at this point. All you have is expenses, unfortunately. So then you move on to the next one, which is your market size and opportunity. So you kind of figure out these different buckets that kind of apply to you. Now, if you did have revenue, typically at a seed or a Series A, you might get a valuation of anywhere from like 8 to 12x. So what that means is you take your ARR, let's say it's $500,000 for the year, and you multiply that. And this is where the multiplication is going to come literally like with the VCs as you keep talking to them. You tell them more about your product. They can look at similar companies. They've kind of, they have more exposure and experience with similar space. And they can kind of help determine where that multiple lies. And that kind of then determines your pre-money valuation. How much money you raise gets you your post-money, and that determines the percentage that the investors get as part of the company. Again, I'm not getting into the details of the actual calculations here. This is, again, just giving you more overall understanding how typically a valuation will work if you're looking at just your revenue numbers. Now, if you don't have revenue numbers, it's okay. Then you move on to the next bucket, which is your market size and opportunity. Investors will typically look at TAM, SAM, and SOM. And I know these are they sound like almost rhyming acronyms. So TAM is really your total addressable market. SAM is your serviceable addressable market. And then you bring it down one step down, which is really SOM, which is your serviceable obtainable market. Based on the resources and the skill set and the tech that you have, what can you really attain from that SAM? That's your SOM. And that's really going to help gauge your potential when the investors are looking at it. And this is where you're going to come in and share that with them. Like this is really the opportunity here, right? So it's great to start with a TAM, but it's so irrelevant that you really need to bring it down to a more granular detail so that the investors understand that you understand your potential market as well. The third point, even if you go with the revenue, go with market size, you go with comparable companies, the team and vision is super, super critical. Sometimes you might not even have a product that you have like some kind of revenue vision on or market size and opportunity because you are really trying to address a combination of 2 or 3 different markets. that's where your team comes into play. If you have a strong founding team that's kind of done it in the past, have a track record of doing this, it's so much easier to get that money. They have the connections, they have the history, they know they've proven themselves before, so they have that track record that strong founding team can really help you get to that nice funding and also give you exposure to a lot more VCs that it might be easier for you to raise your next round. So always keep that in mind as you're building when you're at that seed stage where it's just yourself and maybe another person. Think about your first 10 people. Who are the people who can really make an impact? They're not just helping you build your tech and do other things that you need them to do, but can they also help with the vision and help you get that extra oomph when you go to the investors, right? Last two, it's just comparable companies. You can look at other startups in that industry. Typically, the way VC funding works, they try to give money to similar, like they specialize in a similar sector. So when you go to them, they can also provide you some of these benchmarks because they see so much of this. If it's a larger VC, they probably have invested in a similar company like you or a similar tech like you, that they can give you those benchmarks and kind of help you come up with that number. Last is future projections. Again, you don't have revenue to project, but do you have expenses to project right now? Absolutely. You know what it's going to take. So that's kind of figuring out where both of those kind of pieces go. And maybe you focus on the market size and comparable companies and the team first. And if Nick, if sorry, Chris, if any questions come up, please ping me because mine is on presentation mode and I can't see the chat.
Okay, will do. Absolutely.
Perfect. All right. So a little bit more time I'll spend on this, the understanding of valuations, like the revenue and the traction. Really, one of the pieces you need to understand is what are the KPIs you have? So not only is ARR, which at a company as young as you might not have an ARR, but you definitely have all the expense related KPIs, like your burn rate, your CAC. What does that look like? I was at a panel a couple of months ago, and this VC brought up a really good point. They're like, some of the young startups don't look at their KPIs, don't look at some of the key measuring that they do. All they focus on is just doing the accounting and checking the box. But they said, if you don't measure something, how do we know you're improving it? So for example, today your CAC, let's say, is some crazy number. Let's say it's $10,000 or something. In 3 months, you bring it down to 5,000. In another 3 months, you bring it down to $1,000. That's an amazing story when you go and raise money. Like, look, this is how efficient we're getting. We're getting better at controlling our expenses or figuring out or refining our process where we know how we can target customers and get them and spend less. So I would highly recommend know your numbers and see how you're trying to project and set some targets for yourself. Even at a young stage as you are, maybe you only have two KPIs, and as you get old, as you get more mature, you have more KPIs you want to focus on. But really start measuring these. You really need to know your burn rate, especially a company as young as you. This is where that projection for the expenses come and help you. If you know I need to get this product live in, let's say, a year, and it's going to take me 3 engineers to do that, what's the cost of those engineers? What's the benefits? What does it look like? And that's how much my monthly burn rate is, and work backwards from that to understand how much money do you need to raise. And you can tell the VCs like, hey, if you give me $2 million today, we can go live with this in 2 years. But if you give us 4 million today, we can go live in a year because we can hire more engineers right now. We can go faster to this, and that's what's important. So have your story together, have a best case, a worst case, and an average case for the VC, so they can kind of understand you really know your numbers, and you can then help figure out the money you want to raise. We've already kind of talked about this, other valuation approaches. There's the comparable method where you can kind of just benchmark against other startups. You can do a DCF. There's venture capital. They have the method where they focus on the ROI. And then the last point, again, I've stressed this, make sure you have your team expertise. One of the other things I would say that has happened over the last few years, maybe 5 to 8 years, is there's this whole world of fractional people out there. So these were resources that younger startups did not have access to, but there's so much out there. So you don't have an excuse to say, I can't afford a CMO or a CFO. You don't need to. You can go get these fractional services, and getting that right partner can make such a huge difference for you. So the VCs like it when they see that you have the right team expertise who's kind of guiding you and holding you and it's not expensive. You're not getting them full time, you're getting them for a very small time frame, but they can really kind of help your story and kind of help you grow because they've seen these at so many companies. They have like a huge experience behind them that they can kind of call out things that they've seen and and keep you true to what you're trying to do.
Hey, Ramandeep.
Yes,
We do have a question in the chat. Would you like to answer them as they come, or do you want to hold them to a Q&A at the end?
we can answer them. What
Okay, great. So we have a question from Sunil. Sunil, thanks for the great question. How do you think about valuations of startups that are maybe a little bit newer and have pretty low revenue, call it $10,000 ARR?
Yeah, I would say then you should not focus maybe on your dollars. You should focus more on the comparable benchmarks. Look at other companies out there, look at the market size, what you're trying to solve. Are there other companies trying to do that? So there's going to be a lot of judgment here when you do that. And this is where when you start targeting, like look at other comparable companies and see where they are getting their funding from. Your best bet would be trying to go to those VCs and talking to them as well because they're already in this space. Um, Everybody's in AI. So you have a lot more over there when you're trying to do that. But if it's a very specific product, maybe it's in prop tech or it's in biosciences, there's a lot of VCs and folks that just focus on that space. So it'll be good for you to start talking to them. And a lot of these VCs would like they are great advisors as well. Like they want to know so they have money in the game too, right? Like what if you become a huge success? So they want to talk to you as well. So I would say start maybe somehow getting talk to them, meeting them, getting them as an advisor or talking to them and seeing what they recommend, but really focus on um, the other benchmarks other than revenue. Now, if you're so early stage and you can have 10,000 right now, maybe share how you got to that 10,000. That might be a great story. A lot of this is story weaving at this stage because you don't really have a real product yet, right? Like you're not $1 million company. So there's a lot of storytelling that comes into play when you go to raise these rounds.
Awesome. Thank you, Ramandeep. And maybe just one more related question that we see here in the chat from Raj. Raj, thank you for the question. Um, do you put the kind of the a little bit more the granular financial details, things like burn rate, running costs in the pitch deck, or is that something that you typically recommend lives in a data room, or how do you kind of think about organizing that type of information for investors?
I would say you should have one slide on this. Now, put it in there. That way, the VCs might not spend time on it because it's already there and they get a chance to kind of absorb it beforehand. It just speaks to your finesse that you know your numbers, you're realistic, you know what this takes. So I would like don't do more than a slide. It's just like have one where you kind of call out your key cash metrics that you want to call out, and be realistic. Like don't be growing your revenue 5x every year because you get in 5 years you make $1 billion company. Is that practical? Probably not, right? So be realistic on how your revenue is growing and be realistic also on how your expenses are growing. It can be like 1 year you have like 2 million spent on engineering and the next year it's 500,000. The question will be like, did you fire all your engineers? Like what happened? Um, so be realistic on all of that, like have logic behind those numbers, but one slide should be enough.
Awesome. Thank you, Ramandeep.
All right, moving on to equity and ownership. This is really what your cap table looks like. How much ownership in the beginning, you'll probably just have the founder's equity. I've typically seen mostly common shares here. Don't do preferred yet because the investors like the preferred shares. You want to have multiple classes of share ownership. The investors would want that. So I have in my experience typically seen common shares issued to founders. Um, Huge, highly recommend keeping an ESOP plan, which is your employee stock option plan at the very beginning. This says 10 to 20%, but I have been reading up and there's this huge new theory coming out that maybe this number should be a bit higher, because this is really going to make or break you, right? Like what type of people you can attract. If you go get a co-founder, depending on how important that co-founder is for you, maybe that co-founder should have equal equity as you or slightly below yours, but then your first 8 to 10 hires, we typically see 1 to 2% equity given to them. And again, this number could be even 5% depending upon the skill set they're bringing, how popular they are. One of the challenges you'll have when you get these really new founders or the new hires is what's stopping them from going and starting their own company because they're in the startup, they're working for less money, they believe in this space. So you really want to retain them. You really want to keep them with you. And the way to do it is through equity. That's why they're here. So you make it valuable to them for them to stay with you. Um, and also, when you have ESOP plans in place, when you go to raise the money, if you don't have this in place, the VC is going to ask you to put that aside first, and then they will give you money because they don't want their round to be diluted by this ESOP. So you want to set enough in the beginning that it kind of lasts you through like a Series A at least, because every time you create a new pool, it's always going to dilute the existing investors and the founders. So most of the investors are going to be very conscious if you don't have enough set at the beginning. They'll be like, well, you don't have enough set. You have to turn around in 6 months, do another ESOP plan, and that's going to dilute our equity. And they don't want that. So you want to set the right messaging. This is where the lawyers kind of come into play. They can help you. Somebody like me can kind of help you and with like how much typically should you set aside for this piece. You should be staggering rounds. Like, how do you manage dilution? Like, I'll give you an example for us. When at Mind, we were raising our Series C, I believe. We were trying to raise 50 million. We were oversubscribed. We had almost 70 million that people wanted to give us. And we're like, we don't want it. Because if we give 70 million, that means we're diluting the existing equity. We wanted to keep it at 50 million. So we consciously did not take the extra 20 we were getting. We stuck with the 50. And then 6 months down the line, we went and raised another round. And what that helped us do is it gave us a higher valuation in the second round because the last round was oversubscribed. And the people who couldn't get into the last round wanted to get into the new round, and it kind of drove our valuation. So it's almost like demand and supply, right? Now, timing has to be critical. We did that right before money dried up in the VC space. Now, if we had played that gamble and by the time 6 or 9 months later come to the market to raise money and suddenly VC funding has dried up, which is what happened over the last 2 years, they've gotten, they're holding on to a lot of cash. They're not funding companies like they used to before 2 years. We would have been a completely different situation. So staggering rounds is important, but this is where you have to be strategic to understand the market, what's going on. Do you want to take that risk of staggering it or not? Most of the time, then remember, if you take money from VCs, you're giving them voting rights. Typically, they will get a board seat. So now they have decision-making capability on how you're running the company. Balancing those things is important. That's why the right VC partner is really important for you. If like we were in prop tech, if we would have gotten a board member who didn't believe in prop tech, that would not have been good for us. So you want to make sure you get the right board member from that VC as well, who believes in your product, who understands your industry, and who can kind of guide you as changes are happening constantly, right? Again, vesting schedules typically for employees are very standard. You do a 4-year vesting with 1-year cliff. I've seen some unique ones happen where we brought like a C-suite person and we will give them RSUs, which is the restricted stock units. We've done no cliffs for some of them because we really wanted them. So there's a lot of combination of vesting schedules you can do depending upon the type of skill set you're trying to bring into the company. But typical, very standard is 4-year vesting with a 1-year cliff. Manage your equity through Carta. There's other systems out there. I've only used Carta, and so I can speak very well to it. So just understand all of this kind of going in on a piece of paper. What does this look like for you, and how does dilution happen as you grow through this different stages?
Hey, Ramandeep, a quick question from the chat. What is a good percentage to give a co-founder?
So what I've seen typically is, let's say in the beginning, a typical setup, now again, every company is very different, is you're starting at 100%, right? You're like, okay, I'm going to put like 25 to 30% for a VC to come in. I'm going to put another 20% for my ESOP, which is the 10 people I'm going to hire. So I've got 50%. I would say if it's a co-founder and determine the value, there is cases to be made. Maybe you guys should get 25. Or I've already put in like 2 years into this thing. I want to give them maybe 15 to 20%. So it needs to be significant, almost as significant as the investors coming in. So somewhere between 15 to 20%, maybe. And again, a lot depends. Are you giving them any salary? Are they going to work for free? What does their background look like? Is it going to really help your startup? Are they more generalist and you need a generalist? Or like, is it bringing a skill set that you have, like you don't have that at all? So this person is critical. So think about this. And again, the way I see it is like, it boils down to, do you want a smaller share of a bigger pie, or do you want a bigger share of a smaller pie, right? Let's say you retain 40% of the equity, but your company can't grow because you didn't give enough equity to people, and you've reached maybe a few $1 million, but it's not where you wanted it to be, versus you only hold on to 10% of equity, but now you're a $1 billion company because you incentivized the right people, you brought in the right investors, you gave more of the equity away to raise more money, and now you're a bigger business, right? So you have to figure that out. But I would say if there's just two of you, really understand the balance, because they can see how much you have, right? And there's that piece, like, they might think, why do you have way more than I do when we're both co-founders, we're both working without money here, and we're both trying to build the company at the same time. So be very open and be very transparent with your co-founder about it as well. Whatever number you decide, be transparent to them what that looks like. All right. Just equity across the stages. Typically before seed funding, you've got 100%. Put some ESOP aside. We've talked about this. After your seed funding, your investors will take 10 to 25% of the company. There's just like a bit of an example to kind of show you how it dilutes after your seed next round. So let's say you've got 80%, investors got 20%. You come into a Series A, you typically give, it's a lesser percentage than the seed funding, so you give 15 to 20% of the company now away. So now you've gone from 80% to 65.6% ownership. So that's how the dilution is happening. There's not really, and again, as you go through the other series, your dilution will keep happening. I want to say typically by the time you get to like an IPO, which, so if you've gone through, like, let's say a Series E, typically IPOs happen after Series A, the owners hold less than 10%, if that. All right, next one. It's more talking about the different types of funding you have out there. So there's dilutive and there's non-dilutive. Dilutive is something that's going to come in and reduce the equity ownership of people. There's angel investors. They're really pre-seed people, typically less than $100,000. There's angel investors. There's the VCs out there. There's equity crowdfunding. Now, I know this has been coming up. I don't have any experience with it. I've not seen it. But this is an option that's out there that if you want to, you can research into this. Then there is the non-dilutive funding. You can, like, if you're creating a product that might help, like with a non-for-profit or something, you could typically get grants. The government might have some programs that you might qualify for. There's revenue-based financing. So if you already have revenue, and let's say your collection time frame, like maybe you do 1 year, some kind of subscription, and the customer pays 3 months or 6 months after, you can take that AR and go to revenue-based financing companies. They're called bridge funding companies. You can take it to them, and they will give you a loan based off of that revenue, that AR. They're expensive. Typically, they will charge, I would say, 1 to 1.5% interest rate for 15 days. So that's like 3% a month. So if you see more than that, don't sign. Those almost sound like, I've seen even companies charge 3%. Those are like loan sharks. I wouldn't go to them. So you can find these people at 1 to 1.5% usually interest rate, like the good ones. It's a great way to bridge the gap. If you know you have money coming in, but you want to make payroll, you have to pay for some product, you have to pay for something. This is a great way of kind of just maintaining the control. And surprisingly, a lot of businesses do it. Now, they're not traditional VC-backed companies, but non-VC backed individual businesses will do that, which might be you if you've not raised any funds yet. And it gives you more control over the company because you don't have another person owning equity in your company. And then obviously there's bootstrapping. This is where the balance comes in, right? Like, do you want to bootstrap and own 100% of the company, but it's going to take you 3 or 5 or 6 years to get to where you want to be? Or do you want to go raise money and only own 20% of the company eventually, but you get there a lot faster, right? A lot of the startup folks that I have experience with is people move on. They don't want to do the same company for like 20 years. They typically want to do it like for 5 to 10 years, and then they want an exit. So the typical startup space, that's the profile. If you go look at some of those founders out there, that's their typical profile, is they don't want to be there more than 10 years because they're already bored. They're excited about the next product they're going to do, and then they go launch another company. So kind of keep that in mind when you're setting this up, how much time frame you're expecting here that you want to put in. We'll spend some time on the VC funding. So this is, one of the things I would recommend is as a startup founder is you should always be raising money. Never stop raising money, which means always be going and meeting VCs, presenting yourself, talking about yourself. Because what used to happen before, and again, this is the market's changed now. Before 2 years, a typical gap between two fundraisers, like between Series A and Series B, used to be like typically 18 months. Now it's anywhere from 24 to 30 months. So it's a longer cycle. And typically before, they used to say to close a round, if you wanted to raise money, start 6 to 9 months before you want to raise the money, start talking. But now it's taking longer. So now they're saying start maybe even 12 to 15 months before you want to raise your next round. So this is not something you can say, oh, I need money in June. You're too late. So that's why they say always be raising. One of the things as a founder, now this is where you need to find the right partner is do you have that communication skill set? Do you have that skill set to go talk to people, talk about your product? A lot of tech founders don't. They want to focus on their product. They're into their tech. They want to build that. They enjoy that. And they don't enjoy this side at all of talking to people and talking about the company, right? And this is where the right co-founder would make sense for you, who can kind of balance that for you. Um, Having those right relationships, finding events as much as you can, and going and talking to people. Networking is super key here. And don't be saddened by a no. Like when we were raising our Series C, before we got oversubscribed, we struggled. Like our CEO and our COO, they were both the co-founders. They were meeting people every day, and they presented like so many of these things, so many different places, and it was coming out to be rough. And COVID was just starting, and we were like, holy shit, we're not going to have money. And then suddenly we found the right partner and we oversubscribed. So it's just such a luck game. Who do you meet? Who you talk to? Who the right person is? So always be fundraising, always be talking to people. And if it's just you, I'm I'm sorry to say you can't do it just as you, right? Because you're building the tech as well. So you need the right person with you. You need the right team with you. So find that person for yourself. Typically, VC funding first round is 500 to 5 million. One of the things I didn't put in here is there's this another amazing resource that folks at Seed have. It's the accelerator programs. There's a ton of accelerator programs out there. Every university is doing an accelerator program at this point. I want definitely in California, they're all doing it. There's like Berkeley has their Skydeck. There's the Techstars, there's the Y Combinator. A lot of them don't give you money, but they give you access to a ton of resources. You get access to advisors, you get access to free services, like maybe you get, like some AWS services. I know Oracle does one where they give access to their product. Cloudflare does one where they get access to their product. So there's a ton of accelerator programs out there. Find the right program for you. Typically, these programs last maybe 3 to 6 months. I think every program is unique. So they're kind of churning startups in their program. It's a great network. They can introduce you to the right VCs. They have all these connections. So it's really building those connections. So think about those accelerator programs. Try to get in them if you're very young stage at this point. So then you'll get your seed round, then you'll get your Series A. So again, pros and cons, you have it both. Pros is you get the money, you can build faster, you can grow faster, you get access to a lot of networks, strategic advice. If you raise money, it's easier to raise the next round. Cons, obviously, is you're giving money, you're giving board seats, you're having people who are going to determine how you're going to grow your business. There's also going to be a lot of growth targets. Like we had so many times our board tell us you need to do a restructuring because you're not making enough, like how we were growing. So we had to do a lot of restructurings at my company, and most of them were board driven because we were not hitting our targets. So you are controlled by them at some point. So kind of keep that in mind as you're growing your company. The other, this is SAFE. I don't know how many of you are familiar with SAFEs. This is a new thing that's come out over the last few years. And what this is it's a very simple agreement where a VC or some investor will give you money, but you don't give them equity at that point. So when it happens, it's non-dilutive because you didn't issue any equity. It's like a loan. But the promise is when you raise your next round, that money is going to convert to equity. So it's good for you because you don't have to do a lot of legal work. You don't have to spend a lot of money doing these. You have to go through valuations. Um, and it's good for the investor as well because, again, they don't have to spend all that money on legal and spend doing a lot of paperwork. It's easier and safer, and they'll just give you this money. And then the investor's potential is when you go raise the money, there's different types of safes. I'm not going to get into any of these. I'm happy to jump on a call later if you want to talk more about these. But there's types of safes out there. There's the most common ones are really the safe with a valuation or with a discount. So a safe with a valuation cap is really like the VC is going to say, my valuation, I'm going to have a maximum on a valuation. So let's say they give you money at a 5 million valuation. When you go raise your next round and your valuation is 10 million, they will get the equity at 5 million. So it's benefit to them because they're going to get higher percentage of equity because their valuation cap is $5 million. Same thing, same with the concept with discount. They might say, how much ever equity you're going to raise at, we're going to get some discount on that. And that could be 10%, 15%, 20%. So this is the incentive for the investor, right? To give you money right now because they have a future potential of getting more equity at a lower valuation or at a discount. And the benefit to you as a founder is you don't have to jump through the hoops. It's easy, it's fast. There's not a lot of agreements to sign, and it's non-dilutive at the beginning. And it's not a loan. So if your company doesn't go anywhere, you don't have to pay it back. So, it is like equity, but it's not equity at that time. And there's, like I said, there's different types of safes out there. The most common right now, this is a post-money safe that came out of the Y Combinator. That's really popular with companies right now. So you might want to just spend more time reading about those if this is something of interest to you. Final, just a compare. I just kind of wanted to give you a compare of the dilutive stuff. The angel investor, what's typically their funding amount, how much control you have, typically what stage they come in, and what's the key features. I'll share these slides with you afterwards. You can kind of see the summary later on as well. All right. I think we've kind of covered this as we talk through this is you have to really find what's the right strategy for you. Do you want more control? Do you want more money? Do you have like your revenue? Some folks are like, I want to raise this. Like, don't be aggressive. Don't be greedy. Don't be like, I'm going to go in and I can raise 5. Why not 10? The reason why not 10 is because you're giving more of your equity away at that point, right? So balance that out to see what's the right amount for you. And how you get that amount, that's where that's the piece I'm passionate about is your forecasting, your budgeting, your being that strategic CFO. We can tell you, I can come in and tell you how much do you need. Somebody like me can come in and say, okay, this is how you're projecting your revenue. This is how you're projecting your expenses, and they make sense. And what does that look like for you? How much do you absolutely need to share? And I will work that in there that, okay, typically it takes 24 to 30 months to go raise money. So we need this much money right now for you to be successful, to have a go-to-market strategy and come out and launch your product at a certain time. So those all pieces will kind of come together and help you determine what makes sense for you as your startup. I think we're almost to the end. I want to make sure, I've seen so many financial projections out there that don't make sense. Make sure they're realistic. Don't make numbers based on your gut feeling. I've seen that so much. Like our CEO at our company, he would come up with some new source of revenue. It's like, I feel great about this. I think we're going to make so much. And we were like, based on what? What's the scenario here? What's the reason? What's the reasoning here? And we would track it separately from everything else because we didn't want it commingled in other things. So we could see, is that even true? So somebody in your finance team will help manage that, how you measure it. Make sure your operational costs make sense. Are you only taking in I've seen some companies will start here's a salary. I'm going to pay an engineer at 150,000. Where's that engineer for 150K in the US? It don't exist. But then you can say, oh, I'm going to go international. I don't have to pay them benefits. It's a contractor. So it makes sense. So have understanding behind your expenses. How want you grow? And is it even realistic? How are you going to manage them? How are you going to hire them? Do you know what to do with these? Um, Break even, this was something that nobody even looked at before. No VC cared about you being profitable. Well, I don't want to say no. Most of the VCs did not care about you being profitable all the way up to you a Series D or something. Pre-COVID, pre when the market changed. Then focus used to be just grow, grow, grow. Go spend all the money, grow your, top line. How do you get the more revenue? Do it. However you want to do it, just go ahead and do it. And we'll give you the money to do it. After COVID, when the money kind of dried up, the shift has happened towards profitability now. It's like, sure, we want you to grow, but we don't want you to be bleeding cash completely to get there. So we do want a vision to when do you think that break even is going to happen for you? And again, this is where your numbers are going to speak. Does that make sense? Would it even happen for you? So even though right now you're starting out, have a plan, have a 5-year plan, which is tough to put together for a startup because there's just so much unknowns out there. But start on a piece of paper, have a best case scenario, have a worst case scenario, and have what you think based on other companies. I believe this is where we're going to end up. Have your growth metrics, your KPIs. These are so key. Like what's your CAC? What's your churn? When you do the software you're selling, what do you think other industries, like what are their benchmarks? Some of these you can find publications. If the company is public, you can probably find a lot of this information online. That's a great starting point for you. And then kind of tweaking it from there to see what makes sense for me at this young stage where I don't have the skill set or the resources that they do. What can I do at this point? So keep all of that in mind when you're putting your metrics together. Be very realistic because this is somewhere where people can poke holes in your theory and it doesn't make you look like you know what you're doing if you can't defend your projection. So you can get higher valuations if you have a clearer plan, it's defensible, you can kind of show how you're going to scale. Your expenses really in and out, so nobody can question you like this makes no sense. How would you even do that, right? Like if you're like, I need 3 engineers, this is what it's going to cost me. So keep that in mind. They'll also help you find the right partners for you, right? Like I said, there's a lot of fractional resources out there. Make sure you tap into that resources, talk to different people, find the right match for you, somebody who understands you and can grow with you, not somebody who's just going to come do one project for you and then leave. There's value in it because if you need one-off things, but there's a lot more value if you can find the right partner who can kind of just grow and scale with you until you can get that resource in-house and you can do it yourself, maybe like a post Series A or a Series B when you have the money to do so. And last one, I just want to call out what we do is we provide that fractional CFO, your accounting, your bookkeeping, your compliance, and your forecasting and budgeting. This can speak a lot. Make sure you talk to the right partner, get that person, get your right expert in order to figure out what's the right funding approach for you, what's the right growth approach for you, and where do you see your company like in 1, 2, or 5 years from now.